All right, good afternoon then everyone, as we have a look towards the Fed later on this evening, being the first of the major central banks out this week. Now we do, as you can see on the screen, we do have the BOE and the ECB in tomorrow's session, but we'll have a look at that as we get to it in tomorrow's videos. But today we got the Fed 7 o'clock, as you can see, their interest rate decision, economic projections, and then obviously the press conference to follow at 7:30. Now, no hike expected, which is exactly what markets are expecting. If we have a look back to September, certainly what I think is worth keeping an eye on is the dot plot going forward. Now, if I have a look at this over here, you can see the dot plot in across here. Blue dots are the median figures posted back in September, right? Back in September, they saw one more hike than we are after getting, right? So that's not what we've got. So the dot plots for this year to be revised lower slightly, right? To be revised lower slightly, reflecting no further cut, which they did expect back in September. That has not materialized. They said that to us at their meetings. You know, they've alluded to that, to no more interest rate hikes to come, and the surprise, or that will not be a surprise if that does, or when that does get pushed lower. The dots do move slightly lower into into year end this year. So that's not what we're focused on. What we're focused on is next year, right? Once those then move lower, these blue dots move lower to reflect no more hikes into year end. These the median prints from September then end up being two cuts below where these blue dots would be come through to year end. So judging off the dot plot from what they said back in September, we did not get a further hike, right? They saw a hike into year end, which we did not get, and then from current levels, two cuts down to what these blue levels are, right? So markets currently feel as if they may cut more than that. If we jump across to across the pricing of interest rates, right, and we have a look at March, right? We have a look at towards March. You can see the target rate in basis points, but 5.25550 is the current interest rate, right? Back a month ago, there was a 67% chance, or 67.7% chance of interest rates being there come March of next year, right? A 10.5% chance of a cut a month ago, right? That has now increased to a 42% chance of a cut in March of next year, right? We have a look towards May as well, right? You have a look towards May as well. There's only a 21.9 or 22% chance of the interest rate in May being what it is today, right? So 50% chance of one cut, 26.7% chance of two cuts come through to May of next year. Now, if the dot plot says two more cuts in next year, it means that will be done by March and May. You then got June, July, September, November, December through to year end next year, right? So markets are currently pricing in more than those two cuts, right? They're not fully priced them in, but they're currently pricing in more than those two cuts, right? You then come back to the dot plot, and you've got to have a think to yourself where this ends up come 7:01 this afternoon, or this evening, should I say, right? Do they go ahead and revise the dots for this year down and then leave the dots at two cuts for next year? Or do they move the dots down to three cuts? Even four would be extremely dovish, but do they move it down to three? I think that's where the move comes from, right? If the dots from next year step lower, right, by one, that will imply three cuts into next year, right? But what they've said from 2023, or what they said back in September, is that the interest rate, they'll get one more hike through to year end this year and then cut three times into next year, right? If this is adjusted down and then the dots for next year are not adjusted down, that says to us they only view or see two cuts into next year. If both step down by one, then they will see three cuts into next year, which will give markets a bit of confidence, right? Which gives stock markets a bit of confidence. It should be positive for stocks, should be negative for the US dollar. Therefore, in turn, be negative for yields. Where the bigger move comes is, do they go and push that lower and say there'll be four cuts next year, right? I would expect it to remain the same, potentially at three cuts. Markets will take a bit of confidence from that. I don't think they'll. They kind of, from my point of view, will they want to do three and then potentially be proven wrong and kind of keep talking a good game about interest rates being higher, or are they likely to give in to what markets price in and say we're due to get 3 or 4? I'd probably expect both of these to step lower once, personally, and then that's where I don't think you get a massive move off the back of that, because that's what they've already said in September. They just haven't hiked this year, and they're going to keep the same amount of cuts. So markets will take a bit of confidence from that. Stock should push higher, and that shouldn't really change too much from markets' point of view. It will just give them the green light to go and price in cuts, further price in cuts for maybe March, May, whenever they want to price them in next year. I still think March is maybe a little bit too early, but if they go and say 3 cuts, that probably increases the likelihood of a cut in March. Where you get the big move from, though, I think, is if they go and they say 4 cuts, right? They're going pricing cuts across the board next year over different meetings, and that is a super dovish reaction, or to expect a super dovish reaction. If they go and revise this year's down lower and leave next year's where they are at, that is then a hawkish step. They then no longer see 3 cuts into next year, they see 2. Now, there is a chance for that to happen, right? Labor market is staying where it is. The unemployment rate, we had an NFP last week, unemployment rate came down to 3.7. So the labor market is still strong, right? Growth still remains strong. Growth figures are still positive. Certainly not negative by any stretch of the imagination. So there's no mass unemployment. I say mass unemployment. There's no rise in unemployment. There's no struggling growth. The contracting economy. So growth is still okay. Labor market is still okay, and inflation continues to come lower. That is what they want, right? So there's no need for them really, as of yet, to go and spook markets either way. There's no real need for them to go and spook markets. I think there's also no real need now to go and give markets a chance to just go ripping through the roof. So I think they're probably likely to stick with what they have, revise this year's dots lower by 1, revise next year's dots lower by 1, and then let markets continue to price in what they want to price in. So I can't imagine that this causes too much in the way of reversing of these moves. I mean, you can have a look at the S&P. Stocks over the month of November rallied aggressively up near double-digit percent, and start December this year, dips keep getting bought, and markets have pushed higher across. You can see the S&P, the Dow Jones, the Nasdaq all pushing higher. You can see the Russell continuing to grind higher. Obviously, European stocks are rallying at the minute, but that's not what's on the focus for today. Yields have been pushing lower slightly in December. Okay, they have a bit of a spike higher back end of last week, but over the month of December, at the start of December up here, they have continued their move lower. The 2-year yield a bit all over the place at the moment. US dollar, a bit of US dollar strength recently across a bunch of these, but ultimately the dollar's been pretty sideways across the majority of these different currencies, and stocks is where it's at this moment in time. So I can't see much from today's meeting to go and turn this around. I don't really see why they would go against markets. I mean, I suppose growth is still strong, the labor market is still strong, and they still want inflation to come down. So if they do go and refuse to budge on next year's dots, and then reduce or decrease this year's dots, I think that is a bit of a hawkish step. You might see a bit of a sell-off in equities. You might see a bit of a push higher in the dollar. But ultimately, I think once that's gone, markets will continue to price in what they want to price in into next year, and sort of say, I don't care what the Fed really have to say. So in terms of the initial release, it might be a bit tricky. We'll have to wait and see how these dots come out at 7 o'clock today. Once we see those dots come out, we can then go and make a decision as to what way we want to try and play this. But if they were to keep the same gap between the median from year end this year and next year, you likely need to see one or two participants out of the 18 members push their dots lower, which is a strong possibility. Do they go down 2? Do they go down 2 basis points? That's where you'll get stocks flying. That's where you get the dollar through the floor, and I think that's where the best move, kind of medium term, probably comes. Economic data remains okay. 4 interest rate cuts on the board for next year. That's certainly a reason you go and buy some stocks. But we'll have to see. We'll have to wait and see how it comes out at 7 o'clock. We'll update further on the morning when we get to it. But if you're looking to try and trade it, that's what you're looking for. Certainly, in my opinion, that's what I'll be looking for later on this afternoon or this evening. Probably more this evening, isn't it, for us over this side of the world? But best of luck if you go and try and trade it. That's what I'd keep an eye on. That's what I will be keeping an eye on. Let's hope we can make a little bit of money later on.